Hello everyone. In this video, we will learn how to compute the payment and balance of a mortgage using BA2 Plus Financial Calculator. In this problem, a $350,000 house is purchased by making 15% down and a mortgage for the rest of the amount, amortized over 25 years. The nominal interest rate is 3.85%, compounded semi-annually for a 5-year term. In part A, we are to compute the size of the monthly payment. Since there isn't any indication of timing of payments, whether at the beginning or end of the payment period, as a default, we consider the payments to be made at the end of the payment period. So make sure that the timing of the payment on your calculator is set to the end. Before computing PMT, or the payment, we need to determine the mortgage amount. The mortgage amount, which is our PV, is the difference between the purchase price and the down payment. The amount of the down payment is not directly given, however, we know that it is 15% of the purchase price of $350,000. We take this amount out of $350,000 and get $297,500 for the mortgage amount. Alternatively, since 15% of the 100% of the purchase price is paid through the down payment, we can tell that 100% minus 15% or 85% of the purchase price is paid by the mortgage. So we multiply $350,000 by 85%, which results in the same amount we got using the other approach. In the second step, we will be using the TVM or time value of money worksheet to compute PMT. Before entering the values though, we need to clear the TVM worksheet by pressing second and FV. Now let's enter the given values, beginning with the number of payments and compounding periods per year. To do that, we need to go to the PY/CY worksheet, which is the secondary function on IY key. So we press second and I. We have monthly payment, therefore there are 12 payments in a year. We press 12, enter. We press the down key to go to CY. The number of compounding period per year is 2 because interest is compounded semi-annually. So we press 2, enter. All right, let's exit the worksheet. The mortgage or the loan amount is the present value. So we type in 297,500. Then we press PV. Clear. The interest rate is 3.85%. So 3.85 is my nominal interest rate, or IY. Press clear. The total number of payments in the amortization period of 25 years is the product of the number of payments in 1 year and the number of years in the amortization period. Therefore, in this example, N will be 12 times 25, which is 300. And press N. We clear. Finally, to compute PMT, we press CPT or the compute button, then PMT, which computes the monthly payment to be $1,540.81 rounded off to the nearest cents. In part B, we will be calculating the mortgage balance at the end of the 5-year term. To find the mortgage balance, we will use the calculator amortization worksheet. Before doing so, we need to re-enter our rounded PMT because the actual monthly payment that is made to repay the loan is the rounded version. So we enter $1,540.81 and change the sign and press PMT. We clear. Notice that the payments are considered cash outflow. Remember, going out of your pocket into the bank, and should be entered as a negative value. In the next step, we will use the amortization worksheet, which is the secondary function of PV button, and it uses the TVM worksheet's values to compute the details of each payment. Note that by the end of the initial 5-year term, 60 payments will have been made. So we are interested to determine the balance after the 60th payment. To access the amortization worksheet, press second and PV. Set both starting payment P1 and the end payment P2 to 60 for simplicity, though P1 can be set to any payment up to 60. So we press 60, enter. Use the down button to go to end payment. We set this to 60 as well. Enter. Okay, next, press the down arrow to move to the balance, which is represented by BAL. This is the mortgage balance after the 60th payment is made, or the end of the 5th year. We also round off this value to the nearest cents. Finally, Part C asks to compute the monthly payment for the next 5-year term, where interest reduces to 2.45% compounded semi-annually. We first need to determine the amortization period at the beginning of the renewed term. The new amortization period is the number of years remaining after the initial term. Therefore, given the original amortization period of 25 years and the first term of 5 years, we see that the new amortization period is 20 years. Finally, we will be using the TVM worksheet again to compute the new PMT for the second 5-year term. Before entering the values though, we need to clear the TVM worksheet by pressing second and F3. The number of payments in compounding periods per year are unchanged, but we can still double check. For the renewed term, the starting principal or PV is the balance at the end of the initial 5-year term, which was calculated to be $258,304.71. Note that because PV is considered cash inflow, it is entered as a positive value. Save to PV. Clear. The new interest rate is 2.45. And we clear. The total number of payment in the new amortization period of 20 years is the product of the number of payments in a year and the number of years in the amortization period. Thus, our new N will be 12 times 20, which makes it 240 payments. Be clear. Finally, to compute PMT, we press CPT and PMT button, which computes the new monthly payment to be $1,360.92 rounded off to the nearest cents. Thank you for watching.